Hello everyone, hope you are doing safe. I am really excited today to do this video. I thought of doing this video for quite some time since I started this channel. This video will cover all the technical terms and all the things whatever is available in the stock market. This is for the beginners as well as the experienced trader or investor. We are going to cover lot of topics in the stock market. If you think like the stock market investment is kind of scariest investment among all other investment, don't worry guys, you are not the only one to think like that, because so many people in the world, they are thinking like the stock market investment is scariest investment and you will lose all your money because they didn't know about the fundamentals of investing or how to pick the stock. Today we are going to start from the basics, like what is stock market investing and how to buy the shares and how to place the order and what are different kind of order types and what is IPO or SPAC, what is different kind of like options trading, call options, put options, covered call, covered put, spread, or what is about ETF or index funds, what is about dividend investing, what is mean by passive investment, and how to buy the long-term stocks, how to identify or pick the stock, how long time you should hold your stock, and how much amount you should invest in the stock. What are the risk factors, what you should do and what you should not do in the stock market. Let's see every topic in detail in today's video. Let's cover all the topics. If I miss something, please leave it in the comment below. If you want to discuss about some particular topic in the stock market investment, I will cover about that in my next video or I will reply back to your comments. Let's start like a one by one. Let's start with what is stock market investing. I didn't prepare for this video guys because I thought of taking like some interactive video, like we usually talk with the friends, something like that. So that will be like more helpful and more useful for you guys without reading out some technical terms in some of the stock market article, something like that. Most of the articles, if I read right, I don't understand much with all those technical terms. Let's be in single terms, single language to understand for everyone. Okay, and let's start with what is stock market investing first. So previously meaning like before some years, so it was like the manual trading, like everyone will be in the same floor, they'll be having kind of a paper stocks, something like that, and they will shout like, hey, I have this stock, the company A, let's say Apple, Apple stock for $10, anyone wanted to buy, and someone will come and say like, okay, let me buy this one for this much dollar, and he will sell the shares to the particular person, and it's kind of exchange in a manual way. Now we don't have to go to the particular floor or in order to be in the New York stock market exchange to buy the shares. Now we need only the mobile phone. So in our hand we can buy through laptop, iPad or mobile, whichever you like. You know, mobile is kind of easiest way that you can place order wherever you are, right? So you can go like you never can go wrong with the like brokerage. You can choose whatever the brokerage you like, but this doesn't matter for the long-term investment because many of the brokerage, they are offering like no fee. I'm using 3 brokerage account. I have a Robinhood account, Fidelity, and I do have the Webull. There are few difference in these accounts, let's say on high level, right? So Robinhood account, they do have some restriction and they will open the stock market, like, you know, you can buy the shares or sell the shares only after 9 o'clock, but like a Webull, they will open at 4 o'clock itself. From 4 to 8 p.m. you can buy the shares or sell the shares, you can do whatever you want. Or in my Fidelity account, so I have the capability to start the trading at 7 o'clock itself. So there are few difference within the brokerage, you know, in the as part of margin trading margin, like some brokerage will give like some percentage of the margin based on your portfolio, and some will increase the margin limit, all those things. So there are small differences, but for the long term investment I don't think there is like a much difference between these brokerage account. If you are trading or if you are doing like a day trading, these differences really like it will spoil your trading style and it will make you to lose the money, something like that. But for long term investment, buying and holding doesn't make any difference based on the fee I'm just talking. The Robinhood account, they are giving like one free stocks if you register with Robinhood account. I left my link in the description. If you like, you can please use that, or you can just open the account and start with your trading. To start with the trading in the stock market, you don't need to have like $1 million or at least some $10,000, something like that. With $1 itself, you can start with the stock market investing. There are many options like fractional shares buying. With let's say $10, you can buy 10 different stocks just for $1 each for each stock. So don't worry, like you don't think like I should have more money to start with stock market investing. You can simply start with even a $10, like I said. Okay, so the stock market now it became really easy, or it became really like a digital way that you can buy anytime during our market hours based on the brokerage. Like I mentioned, you can place the order by your mobile itself. Okay, so that is about like stock market on high level. So there are different kind of investment in stock market. Okay, so you can buy the shares in stock market, or you can buy the index funds, or you can buy like index or ETF in stock market. Okay, so let's talk about only these things first, like buying shares, buying stocks or ETF, or buying options. I'm not going to talk about the crypto or mutual fund or bonds, all those things. So let's cover all about this in the stock market. Okay, so now like in the stock market, it's nothing but owning the company, like little part of it, like 0.000 something like that from the company, whoever is publicly traded companies. Okay, so once the company coming to public, people are like they can own the shares of the particular company. You are like some part of the owner, some percentage of owner for a particular company, whichever the stock that you are buying. Okay, let's say when you are buying the stock, okay, or selling the stock, it's not directly going to the company. Like the owner is not getting your money, or he's not giving back the shares, something like that. Let's say you are buying for the company Apple. You are placing order for 10 shares of Apple. Okay, you are not like officially buying the stock from the company. You are like buying the stock from the investors who already own the shares. He is selling the shares to you. Now you are officially transferring the shares from him to your account. So that's how the buying and selling works in the stock market. So now you officially opened the account either with Robinhood, Fidelity, or Charles Schwab, or some other account, whichever the account, Webull, whichever you like. Okay, so now let's see how to buy the shares in mobile. There are softwares for all the brokerage. So now let's talk about what are all different types of orders that you can place when you are buying the shares. Before investing, guys, do your own research. Without doing any research, please don't buy any shares. You should know the fundamental of the company, what it does, and company's financial statements, and what it does for the business and how it's earning the money, all those stuff. So we need to concentrate on company, how it's growing, and how they are showing the financial result periodically. So only then just plan to invest. If you are investing without having any of these statistics, any of these data, So definitely you will end up in losing your money in the stock market. Let's discuss on how to pick the stock little later. So now I'll show you how to place the order in Robinhood account. Let's say I'm planning to purchase Tesla shares. Once I log into my Robinhood account, I have to type in the search bar as Tesla. It will show you the list of companies which is matching to your search list. So if I type Tesla, once I selected, first thing that we have to select the options are invest in dollars or shares. So let me tell you what it means. So invest in shares. So if I plan to invest the Tesla shares as a shares, I should have at least 405.80 cents for buying one shares of Tesla as of current market price. So that's the minimum amount I required to purchase one share. So you can enter how many number of shares you would like to purchase. If I enter one shares, it will show me the estimated cost of $405.8. And if I'm planning to purchase two shares, it will tell you the estimated cost for the two shares. So likewise, you can enter how many number of shares that you are planning to purchase in your account. So let's say you have only $100 sitting in your account. Based on that $100, you cannot place the order for Tesla because the share price is higher than the amount you have it in your account. Instead, you can buy the fractional shares using that $100. So now we have some idea on how to buy in shares based on the share value and based on your account value also. So technically you should have the amount in your account to purchase the shares equal to that share price. Now let's say, like I mentioned, we have $100. I'm going to take invest in dollars. So here you can enter the amount on on Tesla how much you would like to purchase. Let's say I am planning to purchase for $100, so I can enter 100 over here. It will give you the estimated quantity that you can afford for the $100. So for $100 now you can buy like 0.246426 shares. So, okay, so that much shares you can buy if you have $100 in your account. So that's the difference between buy in shares and buy in dollars. So in other words, buy in dollar is fractional shares buying. So you can buy as low as $1, okay, from your account. So if you want to purchase for 10 shares based on $10 that's sitting in your account, yes, still you can purchase with $1 each in 10 shares. Does it make sense? Let's move on to different types of order that you can place while you are buying the shares. Now let's discuss on what are all things that you can see while buying the shares in Robinhood account itself. There are a lot of technical terms, or that's something that you need to know before buying the shares. So let's start with the graph first. So this is like a 1-day chart that you are seeing in the screen. That's how the stock behaved on today. And if I check for 1 week chart, so overall for the past week the shares down for more than 10%. That's like a last week chart, and you can see the stock movement like this. And you can check for 1 month, 3 months, 1 year chart and 5-year chart. So this is how the company performed for past 5 years. Okay, and that's the first thing that you can check for the company. And if I come down here,
you can check like who is the CEO of the company and how many employees are working in the company and the headquarters and the year it's founded. Along with that, so there are some numbers over here that you can check. So first thing is you can check like what's the 52 weeks low price for the company shares and what is the 52 weeks high for these shares. That means in the last 52 weeks, this is the lowest price that the company traded and this is the highest price the company traded. And this is like a low for today's alone and this one is like open price for today. That means the stock started at $393.31 at today 9:30 a.m. and we have high today. That means the share moved till this price. Okay, so that's the highest price the stock traded today. And then there are few other factors like market gap and price earning ratio, that's PE ratio. The PE ratio is nothing but like the investors are paying this much amount for the company earning like a $1. Let's say for $1 of its earning, the investors are paying $989.75 for $1 of earning. That means the investors are expecting the company should earn at least $990 approximately for $1 of investment. And let's see other factors like we have average volume. That means let's say the average volume when the company is trading daily, so they will take average of some days and they'll put it in average volume, and today's volume is this. That means this many shares were traded in the market today. If you calculate the number of volumes with the shares, you will get the market gap. Market gap meaning like let's say number of volumes or some million, we have to multiply that with the share value. You will approximately get that market gap value. And there are some other factors you can see like what are the news that company recently like told to media, and there is something like earning per share. This is the important thing that you have to check before buying any stocks. Okay, so there are like a quarterly EPS for all the stocks. Let's start with the quarter 2 2020. In quarter 2 2020, the expected EPS, that's like the baby green over here, so that's like expected, and that's the actual one that company published during the quarter 2 2020. That means the company delivered the result more than the analyst expected, and in quarter 1 also it delivered more than the expected earning per share. So that means in the last 2 quarter, let's consider these two also. I'm just telling like it behaved really good when we're comparing with the analyst estimate with actual earning per share that they delivered. Earning per share meaning like for every shares it's earning this much. Okay, like earning this much profit, I mean. Okay, so you can check like how many quarters it has successful growth, or it's meeting its expectation on the company, and you can check like how many times it missed the expectation. Let's say in quarter 1 2019 it missed the expectation of earnings, like this is what is expected, and the company delivered in minus 2.9. So that's like a difference in earnings based on the actual and estimated per share. Okay, so these are all the factors that you have to check before investing in any company. Now let's move on to what are all the different types of orders that you can place apart from the buying in shares or buying in dollars, right? So if I need to buy the Tesla as a shares, let me choose that as a shares. Let me go with one, and here there are different types of orders. Okay, Let's discuss like one by one. So you should not go with a market order whenever you're buying the shares. The reason is, so the market will be fluctuating, like the like I mentioned, whenever you're buying the shares, you are buying from some other investor who already own the shares. So he's selling the shares to you. It's like exchange between the hands, right? So if you're placing the market order, Tesla is currently trading at 405, and you're placing it in market order. Let's say there is no sellers with the current price of 405, and there is a seller with the price of 410. That means the share will be purchased at $410 in your account. So don't ever place the market order when you are purchasing the shares. So every time I usually place the limit order. That means when the share is trading at 405.80, so I can place the limit order, either it's equal to the current price or I can place less than the current price, something like that. So if I place, let's say I am placing the limit of price of 405, that means the Tesla shares will be purchased only the price equal or less than of 405. Only in that case that shares will be purchased in my account. When I am placing the limit price, and there are different options over here also, the expiry, right? So if I select good for today, that means it will be active till 6 o'clock today. Okay, so if I place the order in the morning itself, let's say I'm placing it order in the morning 9 o'clock or before 9, so the order will be cancelled after 6 o'clock. If let's say the limit price is not coming down below 405, that means your order will be completely cancelled. Instead, if you want to buy, let's say today or tomorrow, whenever the price comes to the limit price that you placed, you can better go with good till cancelled. That means it will be active for till 90 days after you place the order. So you can use this option for buy or sell. Okay, you can use it for the both thing. And we discussed about market order and limit order, and I told why you should go with the limit order instead of market order. Now stop loss order. Okay, so let's say you purchased a share at 405. Okay, and share is moving down from 405 to 404, 403, 402. You think that, so if the share price moves below to some particular amount, it will go down further. So you need to place a kind of stop loss order to prevent your loss to minimum. Let's say you are predicting that if the share price falls below 401, then it will go further down. So instead I will sell at 401 itself. Okay, in that case you have to select this one, top price. So I can mention like the price where I need to stop, like instead of holding it, it will sell. So here also you can select number of shares that you can place after you buy, and you can select for when it's supposed to expire. If you can select for 90 days also. If the share price falls tomorrow, then it will sell the shares if it falls below the limit price. So probably these three options definitely you will be using all the times.
We are going to discuss about options trading. Okay, so before seeing the different options trading and how to place the order and how it is working, so all those stuff, right? So I'm being honest here, for the beginners the option investment is highly risky investment. Okay, you may be thinking, now we are going to talk about options trading. So before we discuss about different types of option trading, or how we do trade in options and what are all the risk or rewards all those things. So let's be clear, guys. So for the investors who are new to the stock market, it's really difficult for them to do the option trading. So you might be thinking like the option trading is the better for high return, but for the beginners it's highly risky. Whoever is experienced and whoever can predict the market well only can try options trading. There are only few investors they are really succeed in options trading. I'm sure, guys, they all know about in and outs and what is going on inside in the Wall Street. Okay, so we cannot compare with them and our strategy. We cannot predict exactly whether the stock is going to go up or going to go down, all those things. So there will be some inside news, so most of them will be aware. Only those people is a real successor in this options trading. But for the beginners, I would suggest just stay away from options trading and just focus on identifying the best stock for long-term investment. Okay, if you want to know the option trading, let me tell you in detail about each type of options trading. I'll give you the risk and rewards and what you should do, what you should not do about options trading. Okay, let's start. Options trading, so there are different types. Okay, so whatever I highlighted in the green is for the call options, and we'll see the different types first. The first one is call options and put options, covered call and covered put and spread. So these are all the options I do trade frequently in my account. Okay, so I don't trade often in options trading, let's be clear on that. So I do trade whenever I am really confident in options trading. Like hardly I have done once in a month or once in a 2 months when I know when I can predict the stock really better. Okay, so only in that case I will do trade. It's not like I will do like a regular trading for every day in options. Okay, so now I'm going to explain about in detail on each of these types. Okay, but before that let's see on what we need to consider, like what we need to think about before entering into the options trading, right? So we should know all the risk, or we should know when or what and what is it about before trying out all these different types of options, right? The first one is, let's say you will be having the questions like who and when you should consider. Okay, so like I said, so you should consider option trading only after you experienced and you are like good enough to predict. Somehow you cannot predict like 100% in the stock market, but if you can predict little bit, you can start the options trading. Okay, and next thing is, though we have different types of options trading, so there are few factors which are all common across all these types. Okay, so let's discuss about all these common things on these types of options trading. The first one is, all the options trading types has expiry date. Okay, some options has expiry of like a week, or some will have monthly expiry, or something will have like a quarterly expiry. It will vary for each stock. Okay, so that is common, like the expiry date is common across all types of options trading. And next one is lot or contract size. In US, like S&P or Dow Jones or whatever the stock is trading in the America. So I'm just seeing like the lot size is common, okay, whereas in India it's not like common. It will vary based on the stock price, okay, but here it's like a fixed the lot size, it is 100 shares. So whenever you are placing the order for options, you are like technically purchasing or selling 100 shares from your account. That is common. And next thing is the premiums, okay. So when we talk about premiums, okay, so the premium means let's say we have expiry next week, okay. So in the day of expiry, okay, the stock price will be adjusted based on the strike price. I will explain in details when I'm explaining the different types of options, but for now the premium pricing, it will be common across all these types. Let's say you are paying the premium for some insurance, okay. If you are taking for the 1 year time span, you have to pay a lot, okay. If you are paying for a week, you have to pay less, okay. So let's say the premium is high now if you are trading in the options trading, so the premium price will gradually decrease when you are moving to the expiry date. That we'll discuss in detail, and that is common. And how the price is determined, there are different factors when the options price are determined, okay. So there are based on these factors, as I know, as I can tell, like right, you know, these factors determining the options pricing. The first factor is stock price. The stock price, let's say the company Apple is trading around $100 per share, okay. So based on the stock price, so you can find the nearest options like out of range or in the range. It's based on the stock price. The call options, put options, it's all based on the stock price that determines the options trading price for each strike price, okay. That is how the price is determined. And next thing is expiry. Based on the expiry, the price will volatile. And volatility, like let's say when you are purchasing some options, okay, if the stock volatile like up and down, so that's not good for either call or put options, okay. The premium will fluctuate gradually. Let's say you are purchasing a call options when the stock price at 401, that time it was like let's say $12, and stock price moves up to 405, your premium will increase. I mean the option price will increase to $13. Let's say the stock fluctuate and it's coming down to $10, and again it's going back to $13. You will not be seeing the same price whatever you have seen before. That's the volatility of the stock that also determine the options pricing. And demand, this is not like a stock buying and selling. So whenever you are selling some contract or buying some contract, there should be some trade happen between buyer and seller. There should be some demand, like you have seen in many stocks there will be zero volumes for options trading, but few stocks, let's say like Tesla has most volatile stock, so that has huge volume. That means investors or traders are paying more interest into the stock, but like dividend stocks, it won't fluctuate much, so those stocks will have less volatility, okay. So those will have less demand as well. So these are like common factor, and these are all the factors that decides the price movement. I have the small graph over here. So this is how the price will fluctuate. Let's say your price is higher, and this is like, let's say you're buying stock today and you're moving towards the expiry, okay. When you're moving towards the expiry, the price will gradually come down from the high to low near to the strike price, okay. So 100% of the time, this is how the price will move from high to low when you're nearing to the expiry. There's a price movement that's also common across all these types. When you're buying the put options with highest premium, that also will come down gradually how much you need to buy call options, put options, or what are the types of options. So you can buy the call options or put option as low as $1. Okay, so there are some options available for $1, so $1 to like 4,000, 5,000. There are based on different types of strike price. You can buy the lot. Whenever you are placing the order, it's like 100 shares, but that's only the some $100 so is enough to buy the shares. I mean buy the options. Okay, and that's common for all the call and put and all different types of options. And next thing is risks and rewards. Okay, so let's say you wanted to buy 10 shares of Tesla. The Tesla currently trading at some $400, right? So you cannot afford to buy like 100 shares of Tesla. Instead, you can buy the options. That means that technically you are buying 100 shares of Tesla just for the options trading price. If the stock is expected to grow or expected to behave the same as you think based on your options trading, you will get more rewards. That means you'll get more profit than the stocks, because you cannot afford to buy 100 shares of Tesla, but instead you are buying these options with some expiry date. You will be getting the profit of 100 shares before your expiry. Okay, and also you need to wait for till the expiry. Let's say you are buying the options today and you can sell it immediately or next day before expiry on any day. On the expiry date, you should sell your options, otherwise it will be worthless. Okay, so you can have as minimum as amount you want. You can only purchase like 100 shares or like a one lot in options. Okay, the rewards that we discussed right now, let's say about the risk. Okay, let's say you're buying the call options. Call options I'll explain in detail, but let's say call options like you're expected that the stock price will go up, but it's not going up and it's not behaved like the same as you think. Instead, the stock price went down from your strike price that you purchased. That means your price will be worthless. Literally it will be zero. You will lose all your money what are you invested in the options. That's kind of a risk. And there are the premiums, right? I was discussing about the premium pricing. You have to pay like a more premium when you are buying the stock, but it will gradually decrease close to the expiry. That means you have to earn that stock price should go beyond your premium price. You are paying more amount as a premium that you cannot recover if the stock is not behaving the way you expected close to expiry. Okay, so that's kind of risk. Okay, but based on these tradings, right, since if investors are paying more interest with options trading, it can even change the stock price itself. I think you might have heard of SoftBank. They placed all the call options on the tech companies. It changed the entire tech company stock itself in the stock market, right? So this is all about we should know before we knowing about individual types. Okay, so now let's discuss about the individual types in details, how to place the order and what is all about in detail. This is like complete free guide for you guys. Please share it with your friends whoever wanted to know about the options more. Okay, let's start with call options first. Okay guys, now let's see about call options, right? So that's the first option that we are going to discuss right now, the call options. The expectation, right? So the expectation is you are expecting the stock will go up from the current level or from the current price. So it will be in the green, close to expiry or before expiry. So you are expecting that the stock will go up. Let's say today is your buying price at this price, you are expecting that the price will move up. So if you are predicting the stock is about to move up within some specific time frame, you are going to buy the call options. Okay, so let's see how you can buy and how it will be when you are placing the order, right? So let's say currently, let's take the Apple stock itself. So currently the stock is trading at $100 today. I am assuming that 1st of January 0101, the stock is trading at $100. Okay, so if you see the options trading, okay, so you will see lot of expiry date on top of your Robinhood app, right? In Robinhood application, you will see all the expiry date on top of the call options. So let's say today is 0101 and next week you will be having the call option which is expiring on 0107, and there are another options which is available for next week and next month. Let's say 0207, you have one options available on that particular date of expiry, and you can have the options for next year also, or next to next year, something like that. Okay, so let's say, as I said, the stock price is trading at $100. If you see the prices across all these expiry dates, you will see less price for this week and little more price for next week, and if you see for next month, it will be higher than the current week expiry. The reason is you are paying the premium, like I said before. Okay, so the premium, the concept of the premium is when you are close to the expiry, okay, the stock will not move drastically within in range or out of range. Okay, so if you have the expiry let's say next month, so within the next month the stock will vary or fluctuate the price higher than the current price. So assuming that the stock will go from 100 to 150, in that case if you are buying for 150 call options, that will be like within the range before the expiry. So you are accounting that premium amount when you are buying the next month and next year call options. Does it make sense? So whenever you are going for the longer period, you have to pay more premium when you are buying the call options. The reason is the stock movement. So let's say on the closing day, okay, the stock is trading at 100 per share. So the stock will not go to 200 immediately on the closing day itself, right? But next month it can go to 200. So they are accounting that volatility for their premium. That means before next month, right, the 200 will be within the range when it's near the expiry. So that premium you are paying it we are paying before itself. If you are planning to buy for next month call options or next year call options, you have to pay all those premium, and your stocks should react more than that premium amount. That means, let's say the stock is trading $100 per share today and you are buying for next year call options. Let's say you are buying for next year call option 150 call options at the price of, let's say, $100. Okay, that means when the closing date, right, so when it's moving towards next year, the premium will gradually decrease. Okay, so at the time of expiry, your 150 call options, to gain the profit out of your buying price, let's say you bought it for $100, the stock should go up, okay, to above 250. Only that case, okay, so your call options will be more than $100, right? So only that case you will be getting the profit when you are buying the next year options. Let's say you are bidding for 120, you are buying at $10. Let's assume that like that. Okay, you're buying for $10, whatever the expiry it is. Okay, on the expiry date, whether it's month or week or next year, on the expiry date, from the strike price, the stock should move above your premium amount to gain the profit for you. Okay, if you are waiting till expiry date, but before that, if you want to sell, yes, definitely you can sell if you're getting enough profit out of the call options, right? So that's kind of different expiry date and how they are charging the premium amount. I hope that makes clear for you guys. If any doubt, please leave it in the comment. So that's how you are paying the premium amount. On buying time, let's say when you are buying the options, and today let's consider for next week. You are buying for next week, which is 0107 expiry date. When you are buying 105 call options, let's assume like that. You are buying for 105 call options when the stock is trading at $100 per share. When you are buying, let's say the call option is trading at $2.5. Okay, so the call option is trading at $2.5 when you are buying 105 call options. So that is when you are buying, it is $2.5. On the expiry date, for expiry, it can fluctuate, it can go up and down. Okay, whenever you're getting the profit, you can exit. Okay, if you see more volatility, good for the options trading. So better you can sell and come out of the call options, right? So if stock is going a little bit down and it's again coming up, you will not get the same price as you have seen before. Okay, so on the expiry, okay, on the expiry date on 0107, you have 105 call options that you bought it for $2.5 on 0101, but the stock is trading at 110 on the expiry date, which means 105 and 1010, the difference is $5, right? So the 105 call options will be trading at $5. So now the stock price will move here, and this will be like within the range, this is out of range. So whichever the options out of this range, okay, it will be zero, it will be worthless. Sorry, on the expiry day, your stock is trading at $110, so above that price, all the options will be zero, it will be worthless. So whichever the options you are holding below that stock price, you will gain the profit. Let's say holding 105 call options, the call options price will be $5, and if you're holding 100 call options, the call option price will be $10 on the expiry date. So the difference between the expiry day pricing, okay, and the options that you bought. So all this, let's say, like I said, the stock is trading at $110, right? So all these things will be like within the range. It will be within the range, and these are all out of range. So all within range, you will get the profit difference between the stock price and your options price. Remaining all will be zero. That's what about the call options. I hope I made it really clear. And what you should not do now when you are buying all this expiry and all this strike price. Let's say you are seeing the strike price, right? So when you are seeing the strike price, just think about the expiry date, right? So when the stock is trading at $100, you should not aim for like a $200 within 1 week. That means within 1 week your stock price should go up above $200 to gain the profit. That's stupid, right? So you should not aim for that much different for the 1 week. If you're aiming for a month or year, that makes a little bit sense, because the stock can go up to 100%, 200% in 1 year. But if you're aiming for 1 month or 1 week, just aim for the stock volatility and how much you are predicting the stock will move up. Based on that, you have to buy the options. So if you're buying all the out of range options, it will be really worthless on the closing day, on the expiry day. Okay, so let's move on to put options now. Now you have clear understanding on how the premium is calculated and how the options pricing will behave when you are buying and when you are nearing to the expiry. Okay, so without discussing all those details right now, let's move on to put options and what is about put option and how you should trade for the put options. Okay, I'm not going to repeat the expiry date, the premium, all those things. Okay, so put options, so this is another type of options trading which is available. Put options meaning you are predicting that the stock price will go down within the specific time frame. Like I mentioned, it will be like 1 week, 1 month or 1 year. So within that specific time frame, you are predicting that the stock price will go down from the current level. Let's assume that the current price of the stock, it is trading at $100. You are getting 1 week put options. Let's start with 1 week put options. It is like applicable for all expiry date, like I said, right? So you are predicting that the stock price will move down to $90. So you are getting $90 options which is expiring next week at the price of, let's say, $2. Okay, so let me account the premium also, because let's discuss all together. So let's assume that you are buying it for $8. So you are buying $90 put option for $8. Okay, so you're buying this one for $8 on the expiry. Okay, so let's say today you're buying on 1/1, on 1/7 the stock price is trading at $80. The stock behaved the way you expected. On the closing day, the stock price is $80. That means you have $90 put options. The difference between 80 and 90 is $10. So your price will be $10 on the expiry date. Okay, so now you are getting $2 profit, which means $2 you bought it for $8 and the current price is $10. So you are getting $2 profit, which means you are getting $2 into 100, $200 profit on the expiry date. Let's say your stock moved to $70. You have $90 call options. You bought it for $8 and the $70 call option, it's a stock moved to $70, which means the difference between 90 and 70 is $20. Your put option price will be $20 on the expiry date. So the difference between the price you bought and the current price of the put option, which will be $12, right? So $12 into 100, you are getting 1,200 profit when you are buying that put options. So this is in the best case, guys. So the stock is behaved the way you expected, above the premium level, and you are getting profit out of it. Let's say your stock went up from the price you bought. So when you bought the shares, like when you bought the options, so the stock price was $100 and the expiry date, the stock went up to 101, let's say 101, or above your the put option price. Let's say you have $90 put options, the stock is trading at above $90, even $90.05 also, you will lose all your amount that you invested on the put options. So the $8 will be zero on the expiry date. Keep that in mind, like you will lose all your money whatever you invested if the stock is trading little above your put price. Okay, that's the risk I was telling. The stocks should behave drastically to get the profit in options trading. So I hope you guys understood about put options. Let's move on to next type, which is covered call. So let's talk about the risk level first before we discussing on how to trade with covered calls, right? So the risk level, so I would say compared to buying the call options or put options, this is less risky, but there are some eligibilities. Let's discuss in details. So the risk level is better than the call options. The eligibility to do the covered call is you should own 100 shares to buy one covered calls. One covered calls means you are officially selling your shares. Okay, so you should hold 100 shares in your account to do with covered calls options. You are holding 100 shares in your account. Let's go with Tesla now, because we are discussing about Apple a lot of times, right? So let's move on to Tesla. So in Tesla, let's say you're holding 100 shares of Tesla and you're planning to do covered calls on Tesla. Okay, so eligibility, you met the eligibility. So let's say the Tesla is currently trading at $405. Okay, so it's same as buying the call options. You will see all the prices. So whatever the prices available for buying the call options, the same price you are going to sell your calls, sell the call options, I mean. Okay, so let's say the current share price is 405 and next week there will be expiry. Let's say next week expiry call options, right? You are going to sell $450 call options. Okay, so when you are selling this $450 call options, let's say the price is $10. Okay, so you sold 450 call options at the price of $10. When you are selling the call options, the good thing is you can use that money. It will be available in your account immediately when you are selling these call options, which means $10 into 100 will be like $1,000 immediately will be credited to your Robinhood account or the brokerage account. That money you can use it for any other trading, whatever you like to buy or sell, whatever you wanted to do. It's credited to your account. Okay, so that's the beauty of selling the call options. Okay, so you sold the call options. Now you are waiting for the expiry date, right? Waiting for expiry date. So now the covered call options, the thing is that you are capping your profit to $450, which means at any cases you will not get the profit if the stock price move above $450. So that's like a drawback in covered call options. Okay, let's say you are selling the covered call of $450 and the stock price move above $450 before the expiry date, you will not get that profit because you are capping your profit to $450. That's the one drawback in the covered call. And another drawback of the covered call is if you are doing it in the dividend stocks, you will not get that dividend amount if you are in the X date itself. The reason is you already sold the shares, right? So it's not considered that you are holding the shares in your account. You are not eligible for the dividend. So you will lose your dividend and you will lose your big profit if the stock moves drastically or whatever the price that you sold it for. So if the stock is moving above that price, you will not get that profit and you will not get that dividend. So these are two disadvantages with the covered call options. Let's see based on the stock movement how you are getting profit and how you are losing the profit, right? So you sold the $450 call options and on the expiry date, let's say the stock price is trading below $450. Okay, that is like a best case scenario. The stock is trading below $450, which means on the expiry date, let's say the stock price is $445 on expiry. Okay, on the expiry date, the stock is trading at $445, which means that's less than $450 that you sold it for, right? So the call options will be like worthless, right? So you sold it for $450 and with this not like within the range or in the range when on the expiry date. So we'll get all your premium in your account. You don't need to sell any of your shares. So you'll be getting $1,000 profit on the expiry date. Your 100 shares will be in your account itself and you'll be getting the premium also, which means you are getting $1,000 additional profit for just holding the stocks. That's a good thing, right? So that's the best case. And let's go for another scenario. The stock price moved to $470. Okay, Now that's the second options. Now the second thing is the stock moved to $470. Okay, when the stock moved to $470 on the expiry date, now you supposed to lose all your share which are you are holding in your account, but you are getting that premium back. That will be in your account itself. You're not losing the premium, but you're losing your shares at $450, which means even though stock price is $470, you're not getting that extra $20 profit. You are now supposed to sell your stock at $450, right? You're losing this 470 minus 450, $20 profit, but still you are getting profit, sorry, $45, because you bought a share at $405 and you're getting that difference between your buying price and the strike price. So you are getting $45 by holding 100 shares, that is 4,500 plus the premium amount that you sold for the covered call. Let's say the premium amount is $1,000, so 1,000 plus 4,500 on the expiry date, you are getting 5,500 as a profit. Does that make sense? Okay, so compared to buying the call or buying the put option, so this is like little bit safer. There are two drawbacks, which is not like huge losses for you guys. So this is kind of better trading style if you're holding 100 shares of highly volatile stock or highly demand options available stocks. So this is all about covered calls, guys. Let's see about covered put. I just took my red marker because we are going to talk about the put. It's down, right? So let's talk about covered puts now. So it is like opposite to covered calls. The risk level is little less than buying the puts. Okay, so let's talk about this one. So first let's talk about expectation. Okay, so let's say you wanted to buy some company shares which is trading at $500, let's say like that, but you didn't want to pay the $500 to buy the 100 shares, but you have 100 shares worth of money in your account. Let's say you have 50,000 in your account, but you didn't want to buy the stock at $500. Let's say you wanted to buy the stock at $450, okay, but you're not getting that price for now. That means definitely you should pick this covered put. I would suggest for that one. The reason is, okay, so you'll be getting that premium, that what are you are expecting, that $50 difference when you are doing this covered put options. So for that one, you should have the amount to buy the 100 shares of some shares. Let's say, like I said, like you have $50,000 in your account. You can do the covered put with this amount when the stock price is at $500. Okay, so and the risk is less and expectation is you need to get the stock at lower price than the current price. Okay, so let's say you're doing the covered put of $450. Okay, so the $450 premium amount, when I say premium amount, like the premium difference of the expiry, let's say for the next month expiry put options you are doing it. Okay, so you are paying like let's say you are selling that put for the $50. Okay, so and now you are getting that $50 premium, which is $5,000. Okay, in your account if the stock price closed above $450. That $450 is your put option strike price, right? So if the stock is closed at above $450, you are getting that premium along with 50,000 whatever you have it in your account. That means in your account you will see 5,000 at the expiry date. So you will see 55,000 on the expiry date without owning the shares itself. Just having the cash in your account, you are doing the covered put, you are earning that premium in your account. If the stock price is above $450, let's say the stock price went down below 450, okay, which means that is in the range of your strike price, right? It's not out of range. Out of range means everything will go to zero. So now it is in the range on the expiry date, which means you have to buy the share at $450 using this money, whatever you have it in your account. Okay, so that means let's say the stock on the expiry date, the stock moved down to $400. So even though the stock moved down to $400, since you sold like you did covered put with the $450, you have to buy the stock at $450. You're not getting that $400 when you're buying the stock. That's like a drawback in the covered put, but still you're getting your premium amount, whatever you did for the put options, and you're getting the premium amount plus you are getting that share at $450 instead of $500. Okay, the stock price is maintaining at up, so you'll be getting all the premiums gradually when you're doing the covered put like with every expiry date. Okay, so I just told about above your strike price and below your strike price. So just leave in the comment below what you guys think about this covered call and covered put compared to call and put options. So that's less risky than this is less risky than buying the call and buying the put. Okay, now let's see about a spread. This is kind of less risky and the investment also less compared to buying the call or covering the call or put or buying the put. This is less risky and less investment. So this is better than all other types, I could say. That's my personal opinion. Just leave it in the comment like what you guys think about this spread. Okay, so let's talk about the spread, how it's working. The spread, so it is same like buying call and buying put. The strike price will be common. It's like already we discussed about the common things about the price movement and premium, all those stuff, right? So now let's see how to place first, how to place the order. This is like a little trickier than directly buying and selling the call and put. So in the Robinhood account itself, if you go to trade options on the particular stock, you will see all the expiry date, all the buy, call, put options, everything. On top of that, you will see something like a select. So once you selected, you can do this spread thing. You can select multiple call options or multiple put options. At the end, you will see like a net cost that you supposed to pay to do that spread. Spread means like you are spreading your buying among the calls and puts. At the end, based on the stock price movement, the price will change. I mean, your spread price will change, and based on the difference between whatever you bought or sold, you will get the profit. Is it confusing? So let's see with some examples. Okay, so let's say currently the stock is trading at $100. Okay, and what you are doing is you are going to buy 105 call options, which is trading at $15 currently. Let's assume that I'm just making this up. So the 105 you are buying at $15, and at the same time on the same trade you are selling the 110 call options at $10. The difference is $15 minus $10, $5. So we'll end up paying $5 multiplied with 100, the lot size. You will pay only $500 when you are doing this spread. The difference between buy and sell, that means literally you are selling 100 shares at 110 price, strike price, at the price of $10, and you are buying 105 strike price call option at the price of $15. So the difference is $5 you are paying for your spread when you are buying that spread. So when you are investing only $500, and let's say on the expiry date the stock price is 108. Okay, that means your 105 call options will be $3. It will be trading at $3, and 110 call options will be trading at $0. That means you're getting only $3 back out of your investment, which will be equal to $300. You're losing $200. Let's assume that you bought the spread at $2, difference between these call options, okay, and at the end you are getting like a $3 difference between these two call options, and then you'll be getting like $100 as a profit. So the profit also will be limited and the loss also will be limited when you're doing the spread. Does it make sense? I hope this example is more clear. And if you consider some other example, like let's say you are doing like a 105 and a 1010 call options, and the stock price moved up to $120. It's beyond your buy and sell call limit, right? Let's say the stock price moved to $120. In that case, your 105 call options will be like $15, and 110 call options will be like a $10. The difference will be $5. Let's say you bought it for $3, it will be like a $200 profit. If you bought it for $5, it will be like zero profit. So that's how the spread I just told in simple terms and simple understanding, without any technical terms, technical graphs, everything. So I hope you guys got it, like what's going on with the spread. So I hope I covered all the options tradings types: call options, buy options, covered call, covered put, and spread. I hope you all got what it's about and how to trade with that. So please let me know if I missed something, or if you wanted to know or some different scenarios. I will definitely answer in the comment. Okay, I'll definitely answer, guys. So let's move on to the different topic now. I hope we have discussed a lot about options trading, because there are a lot of hidden things, as you see here in the options trading, that you should be aware of before trading the options. Okay, so now let's move on to safest investment. Safest investment meaning, like, compared to these tradings and or like options, calls, puts. So let's go with the smooth one. Let's move on to the dividend investing, my favorite topic, guys. So the dividend investing is kind of a little bit boring for many of the investors in the stock market, because they will not see like a huge growth like they are seeing it in the growth stock. Let's say Tesla, it's giving like a 500% growth from the buying price, and whereas in dividend stock it will not go like that, it will not grow like that, the stock price. Okay, so that means the growth stock, meaning it has a lot of innovation ideas, and they are going to implement in their business that will grow the business like anything. Okay, so in Tesla, for example, they have a lot of innovation ideas that they're going to do it in the future. That's why they're not paying any dividend to the shareholders. Okay, whereas let's say some energy stocks, right, some real estate investors, they are going to do only the real estate stuff as a real estate company, and energy companies are going to do like only the energy thing. And let's say the banks, right, the banks pays good dividends, right? So because they're not going to innovate anything, they're going to stick with that business, and they're going to be stable in their business. So let's say Coca-Cola, right? So Coca-Cola is paying the dividend, which means they're not going to innovate any new thing as a company. But until people drink soda, the company will be there. The company will be there, and it's sufficient to run their business, and they have enough cash to pay to the shareholders. Let's say the company earning $100 out of the investment, they are paying to all the shareholders. Let's keep the money, and they are spreading to the shareholders who are investing in the company. Okay, that's the difference between the dividend stocks and the growth stock. So people preferably go to growth stock, because the return is huge in the growth stock compared to the dividend stock, right? But from my perspective, right, my perspective, the dividend stock is safest, and without any risk. You will not say it's like huge risk like growth stock. So I have some sample to discuss about why I'm saying the growth stock investment is a risk compared to the dividend investing, right? So let's say I bought 1 million shares of Tesla, I cannot afford to buy that much shares, but I'm just telling as an example, right? So I'm buying like a 1 million shares of Tesla, which is like 6 million. Let's assume, I'm just making this up. So 6 million worth of money I invested in the stock market, like that's Tesla, in one company, right? It's not paying me back any dividend or any interest or any as a payment. It will be in the digital cash in my account till I sell the shares, right? So let's say the stock growing at like from 6 million to let's say 50 million. Okay, so I'm not selling my shares, I'm holding it in my account. At some point, let's say after my age of 60, that's my retirement age, let's say like that. So I don't know, like expecting I will retire at 60. I'm expecting to retire at 40 or 50 based on my investment strategy or passive income thing. So in that case, at my age of 60, if I invested in the Tesla stock, let's say at that time the Tesla stock dropped, the business failed, the innovation failed, something happened to the stock, and we can't guarantee anything, right, in the world. Let's say they're hiring like a different CEO than Elon Musk. Elon Musk is out of Tesla, so the stock price dropped so much. Let's say the model got failed, so the stock price dropped so much from my 6 million to 2 million. I'm losing all my money, I'm not getting anything out of it. Instead, if you invest in the dividend stock, let's say I invested my 6 million amount of cash in the dividend stock, every month it's paying, let's say 4% also, it will be paying like, I'm just making this, I'm not making any calculations, let's say $25,000, it's paying me as a dividend for a year. So that $25,000, it's still huge money for your retirement to live healthy life. And so those kind of thing, I'm just telling, the dividend investment is worth compared with growth investment, because you are getting like enough cash to live in your retirement life without spending anything, without lifting your fingers. So you can sleep peacefully, and every month that the empire whatever you build in your stock portfolio, it will pay you as a dividend for your living. But growth stock, you are not getting anything out of it till you sell the shares. So that's how I'm seeing the comparison between growth and dividend stock investment. So the dividend investment, there are a lot of dividend investment stock which pays monthly or quarterly or 6 months once or yearly once, something like that. But I would suggest don't go for highest return dividend stock, because it's not safe to invest. Okay, just look for 4 to 6% dividends per year. That is like a safest investment if you are considering for the dividend. Even I have made a video in my channel about like a monthly payer, and definitely I will update you guys about what dividend stock you should buy for every month to live peaceful life after retirement. Okay, so I can talk for an hour also about dividend stock, because I'm like more, it's like close to my heart. I'm like more into dividend stock than the growth stock for my long-term strategy, because growth stock, I'm not like that brilliant to identify the future business. I cannot like throw the arrow to place it in some point or some business or something. I cannot predict the future, right? So I can go with whatever is needed for the life. Let's say Coca-Cola, AT&T, all those basic, let's say Coca-Cola or AT&T, all those basic company will be there for as long as my retirement. So that's enough for me to get my life leading without taking any risk, because we are not from the family that has like they are like rich people or millionaires or billionaires, something like that. So we cannot take that risk, right, by losing our money, hard-earned money. So the dividend is kind of a safest investment that will pay you money when you sleep. So you don't need to do anything for the dividend payment, but till some amount, so that's kind of tax free when you're getting the dividend. So if you're getting some dividend above the limit, you're supposed to pay the taxes. Okay, so I believe for the individual investors, it's like approximately 30,000 something. I'm not exactly sure about it. So if you're earning the dividend less than that amount, you don't need to pay any tax. It's completely tax free in your account. Nothing other, like no other investment will pay you without tax free income. So the dividend investment will pay till certain limit, but if you are crossing that limit, then only you have to pay some taxes. But if you wanted to live like a peaceful life, instead of considering the growth stock or taking the riskiest investment, I would suggest let's just go for the dividend investment. Even the dividend is paying like little bit less money compared to the growth investment. So once you get the dividend, right, just reinvest the same dividend with some other stock. It will grow your money, and the reinvestment and the compound interest will do the magic for you. So that compound interest will grow gradually, and it will make you like a better return when you're retiring the money, when you're retiring officially from your work. So the money will not retire. The money, that empire that you build when you work, that will pay you back when you retire. So that's for the dividend investment. So it's like same as other companies. Just find out the good dividend stock and good companies that pays you dividend for every month. Okay, so that's all I do have for the dividend investment, guys. Definitely I'll make a lot of videos about dividend investment and what stock we should buy for every month. And for this month I'm going to make next video on what dividend stock you should buy for this month. Okay, just wait for that video. Now let's talk about index or ETF. So like I said, the dividend investment on the individual stock, it is safest investment. Along with that, the indexed fund investment also is safest, even though the Warren Buffett mentioned that S&P 500 is the best investment, like everyone should consider, right? So even though S&P 500 is like, that's one of the example I'm just talking about right now, and there are some dividend ETF or some growth ETF, let's say ARKK, it has Tesla and Zoom or lot of growth stock in it. So you can find the perfect ETF whichever is suits for you. I will make a different video on what are all different kind of ETF you should consider, on what basis you should invest. But meanwhile, if you're investing in the ETF, so you can consider the dividend ETF or growth ETF or index ETF. Index meaning there will be like a bunch of shares when we are seeing the market, right? So we are considering only S&P 500 or Dow Jones. So there are list of company listed in S&P 500, and there are list of companies in the Dow Jones, and there are mostly tech companies in Nasdaq that is being included in Nasdaq, S&P and Dow Jones. You can either invest in indexed fund. If you want to consider the whole stock market, you can invest in VTI simply. So without taking any risk, if you invest in VTI, it's spread across all the stocks in the stock market. Okay, so whenever the overall stock market is growing up, so you are getting the profit. So you are like a owner of some percentage in all of the company listed in the stock market. So just don't consider that you're owner, but there are some 0.00000 of percentage of owner in all the company that's publicly traded in stock market in America. So if you buy the VTI stock, okay, so you will never go wrong in buying the indexed fund, because S&P 500 is kind of safest 500 companies in the America, in United States, right? So if some companies are not behaving as the Wall Street like as the like eligibility criteria, they will remove the company and they'll replace with a new one, which means still it's S&P 500. Top 500 companies is trading in S&P 500. So simply put your money in the indexed fund and just forget it, and don't think that like this is like highest in the market. So today highest is tomorrow's lowest, guys. So don't predict the stock market, just in the market. That's the main thing. So don't time the market, so just in the market. Okay, so don't think about like ups and downs in the stock market, just blindly invest in the indexed fund. You will be safe. After 60 of your age, you will have enough money to retire. I'm sure about that. Okay, so let's talk about what is ETF, right? I told a lot of things, but let's see what is ETF. ETF means like, there'll be group of companies that's like invested together with some percentage as a one ETF. Let's say ARK, like I mentioned, they have Tesla, Roku, Zoom, all the growth companies, and they are investing in some percentage. If you buy one shares of ARK, it's spread across all the shares that was included in the ETF. Okay, so it's like diversified between all the shares in the ETF. Okay, so instead of you pick the individual stock, so they have the bunch of stock that are diversified with some percentage. You are buying one shares that is equally diversified. So the risk wise it little less risky compared to compare it to a hand pick of individual stock, right? So you can simply put it in S&P 500 and forget the money and just consider that money is no more for you, and just see after 60 of your age, definitely you will see huge growth, and you will never expected like that much amount in your life after your retirement. So please consider dividend investment and index fund investment or ETF investment. That's like safest investment compared to this day trading, options trading, and buying the individual stock, or doing the day trading or penny stocks. So all those investment. Okay, so don't play your money with this roller coaster thing, because your hard-earned money, like don't allow others to eat your money. You should spend your money in your life. Okay, so that's my advice, guys. I know conclude the video, right? So we discussed about how to buy the shares in the stock market, what is stock market, and how to analyze the stock, and how to do options trading, call option, put option, covered call, covered put, spread, all those things. And also we discussed about dividend stock investment and indexed fund, and also like let's talk about how long time you should hold your shares and how much you should invest. So there are some main things that we have to discuss. So how much you should invest, right? That's the major questions. Like I'm seeing like in many forums people are asking how much I should invest. Okay, so as per my view, you should invest as much you can. Okay, after you are spending, you have to invest as much you can for the better living for tomorrow. Okay, so how long time you should invest? For that question I can answer like long term, like don't think the near future. So the good investors, they will not see like tomorrow or next quarter or next month. Okay, they will see for the decade, some decade after some 60 or 40 years once they retire. So they will see all their investment that is paying back to them, something like that. So how long time you should invest? You should invest for very long time. How much you should invest? You should invest as much you can, because today's money, it's worth less than yesterday, right? So the inflation is gradually increasing. So based on the inflation, you should not hold any cash in your account. Instead, just find out some better investment options that's for your life. In next video, I'll be posting like what stock you should buy. So this is like educational video. I will discuss lot of things, and let me know in the comment what else you should know about the stock market terms or stock market tradings or options, whatever I missed already, right? So just let's discuss in the comment, and I'll post the next video about that. So see you soon, and happy living, safe investment. Take care, guys. See you in the next video. Bye. And please subscribe and hit the like button before you leave. Thanks for watching this video.